Good morning. It's Jeffrey Christian of CPM Group. It's about 11:40 in the morning on Friday, the 13th of June here in New York. I want to focus mostly on silver today, but given the state of some of the things that have been happening, there's a wide range of topics. So I will talk a little bit about the gold, platinum, palladium markets, what the prices have done, what we see going on there. Then I'll go into silver, and I'll talk a little bit about silver and some of the issues that people have been saying that probably are not. No, I'm sorry, they're not probably. They are, in fact, quantifiably inaccurate. And investors and other market participants ought to be aware of that. I'll show you the results of the 30-year Treasury bond auction yesterday. Again, people were predicting a disaster that didn't happen. And then run through some CPI and PPI numbers. Yeah. Basically, we are in a situation that has gotten worse as expected. Politically, economically, socially, the United States is more divided. There are problems around the world, politically, domestically, internationally, economically. Economic data, which I'll talk about in a little bit in the end. One of the misrepresentations that is very common right now in both the mainstream press and also in the dark corners of the ignorant parts of the internet is that if you look at economic data, you don't see negative consequences of some of the economic policies that have been put in place over the last 4 months. And the reality is you shouldn't expect that. We'll get into that when we get later in. But the reality is that you have increased risks that have actually gotten heightened over the last few weeks with political problems in the United States, divisions within the Republican Party, divisions throughout the society. And now, as of last night, the long-awaited attack of Iran by Israel. Something like 200 jets were involved in the raid last night. The price of gold was somewhere below we had a target that we thought on an ultra short-term basis, the gold price could reach $3,450 by today. And it was about $30 below that yesterday at the close of business. But after the Israelis bombed Iran, the price shot up. It got as high as $3,468 this morning for the August Comex contract. And as we're speaking, or as we started to speak here, the price was $3,448. Our expectation has been and continues to be that the price will continue to rise. We would not be surprised to see $3,500 within the next week or two. All of the economic and political factors that have been causing investors to buy more gold, pushing the price higher, aren't in place and are, if anything, deteriorating more. They're not getting better. They're not dissipating. And we think that in that kind of environment, investors will continue to buy increased amounts of gold, and the price will continue to rise. Now, we had as our main economic outlook, or our main gold outlook, the idea that you could see some seasonal weakness in gold prices over the next 3 months, June, July, and August, possibly into September. There's a seasonal weakness in investment demand and fabrication demand that sometimes causes prices to back off. And we were saying that we would not have been surprised to see the price back off possibly as much as $3,000 or even $2,900 over that period of time. We pointed out that we were saying that with the proviso that if the economic and political environment were worse than anticipated, that could override the seasonal weakness, if you want to call it weakness, in prices, and cause the price to rise. That's what's happening. Now, let me back up a little bit and look at $3,000, look at $2,900, and you'll see that those are prices that have not been achieved in the gold price prior to, well, for 2,900 prior to February and March of this year. And for $3,000, it was March that we first topped $3,000. So the idea of some price weakness, which still is there, down to 3,000 or 2,900, is not out of the question, and you should be taken in as what it is. You know, the price would still be higher than ever before prior to this year. So we are in a bull market, and it's inspired by the economic and political developments that continue, and an increased amount of disinformation on the part of governments, on politicians, people who market precious metals, people who market other things too. You know, we saw, for example, a meeting in London of U.S. and Chinese trade representatives. They reached an agreement. The agreement was that they would continue to talk about what to do with trade and tariffs. That's all they agreed to. But yet you see the U.S. government saying that the tariff trade war that it had started with China has been resolved. No, what was resolved was we'll continue to talk about it. And in that instance, China has almost all of the cards at this point, depending, you know, regardless of what some people want to say. So those problems continue. They have not been resolved. Looking briefly at platinum and palladium, earlier in the week, we did a video that really focused on platinum. We said there were two sets of factors that were really, well, three factors. You know, one was there's a lot of marketing hype going on about platinum. Oh, there's this massive deficit, which actually doesn't exist. And oh, the Chinese are buying a lot of platinum jewelry instead of gold because of the price differential. And Chinese jewelry demand, if you take our estimates from last year, rose about 32,000 ounces. If you take the promoters' estimates, it rose maybe 150,000 ounces or so. You know, that's enough to support the price, but it's not enough to really move the price sharply higher. And then, oh yeah, the auto industry is going to recover and start using more platinum. None of those factors really seem to be that potent. Now, the platinum price, which had been trading in a range of 900 to 1,050 for most of the period since the middle of 2000, well, really going back going back a decade, really, to 2015. But, you know, it has been in that range, and it has stayed in that range. And 2 weeks ago, it was around $1,000 an ounce. And it shot up. It shot up to 1,100, which took it out of that range with a 1,050 cap. It took it as high as it has been. You know, it hasn't been that high since June of last year. And it's important to note that was June of last year, because July is an actively traded contract on the NYMEX, and you have relatively large open interest in the July contract, and you're now 2 weeks from first delivery date. The price came back off to 1050, but then it came back up, broke above 1,100, and it shot up. It shot up to, I think, about 1,270 or 2,080. $280 an ounce, and it's come back off. It's $1,214 an ounce. It's two sets of factors. One is that NYMEX roll, which is going on and probably is helping to push the price up. And the other one is speculators or investors buying based on the marketing hype that they picked up over the last 4 weeks or so. So our expectation is that at the right point, which is probably going to be in July, you'll see platinum prices come off and go back probably into that range of $900 to $1,100. The auto industry has been suffering and it's going to continue to suffer from economic weakness. People are buying fewer cars, they're buying somewhat large, increased number of cars in March and April in advance of concerns that the auto prices are going to shoot up because of the trade war and tariffs being imposed on autos and auto parts. And I'll say it here, and hopefully I'll remember to repeat it when I get into the CPI and PPI. One of the things that you keep hearing is, well, the tariffs haven't really caused sharply higher prices or a sharp decline in production and demand of goods in the United States. That's because most of the tariffs have yet to be agreed upon. And even those that have been more or less agreed upon, some of them are unilaterally agreed upon by the U.S. government, have been suspended or temporarily suspended or put in, on hold until later. So we really haven't seen the real financial consequences of tariffs yet. And that's true in the auto industry, which is so important to platinum palladium, but it's also true in the broader economy. You shouldn't be surprised that you're not seeing the effects of tariffs more strongly because most of the tariffs have been only threatened and not executed. And I have a thing about people who threaten and make threats. So that's where we are. And I put in this longer term price chart to show you that you've really been moving sideways for a decade now in platinum prices, and you're far from the $1,800 to $2,000 prices that you saw when investors were much more interested in the metal, 2007 to 2012, 2013. Palladium, a very similar situation. Again, you've seen the price trading in a broad range. It has broken above that range. It got up to $1,050 this morning, $1,047 this morning. It got up a little higher earlier in the week. Again, we think it's something of a false start, and our expectation is that the price of palladium will fall back. I will say that we had not expected the spikes to be as strong as they were on the upside. We were thinking that the prices would stay within the recent trading ranges. So I want to turn to the silver market. Silver prices right now, as I started this, were $36.30. This is down a little bit from, I guess, earlier this week. They got up to $37 and they've come off a little bit, but you have a pretty strong market. Now, I will excuse myself or apologize for looking over here, but I do have a lot of notes to go. Our expectation is that you could see $37.50 within the next week or so, and $38.50 within the next few months. You could see even higher prices because one of the factors that's going on is the large open interest in the July Comex open contract. You have, as of yesterday, 468 million ounces of open interest in the July Comex contract. Right? So there has been a sharp decline from like 519 million ounces last week down to 468 million ounces yesterday. But it's still very high, the open interest, and that has to be rolled forward, which means that the people who are short, the companies and banks and trading companies that are short the COMEX, these are long-term hedges. So they're always rolling them forward. They're not speculative positions. They're not naked. They're not betting that the price is going to fall. These are hedges of physical positions that these banks and brokerage houses and industrial commercial companies have, and they're hedging their inventories, their long physical silver, with futures contracts. So they're always rolling them forward. That's why they roll them forward as opposed to close them out. They're not investors. They're not exposed to the silver price on the downside or the upside so much, except that they make more money with the silver price higher. One of the jokes about these silver conspiracy people who think that banks suppress the silver price, the banks would be trading against their own best interest if they suppress the silver price, because banks don't make money on rising or falling silver prices because they're 100% hedged. Banks make money by lending that silver out. Let's say that they are lending the silver at 3%, right? And if the price of silver was $22 at the beginning of 2024, but it's $36 now, that's $14 higher, roughly, actually more than 50% higher than it was 15 months ago, 16 months ago. They earn more money at 3% of $36 an ounce than they did at $22 an ounce. Yeah, and I've explained this repeatedly, and I know some people have some sort of psychological problem that they can't agree or understand that. Other people are a cottage business. They are silver conspiracy theorists, and they make their money by scaring people and saying all kinds of things that simply aren't true, right? So, I mean, I remember beginning to explain this in the early 1980s. And there's still people who still don't understand it or still refuse to understand it. The cottage industry, that's their business. That's how they make money. They're not going to ever stop saying that. Some people are true believers. They have some sort of psychological hang up. They will always believe that. Other people say, hey, something's screwy in the world. I don't understand it. This conspiracy theorist has a theory that maybe it holds water. Those people can actually be educated and move away from the inaccurate views of commodity markets and move actually to make more intelligent and informed and educated investment decisions in silver and in other commodities, as well as in equities and currencies and bonds. So that's what's going on. You have a large roll that's yet to come. We are now the 13th of June. It's halfway through it. Over the next 2 weeks, most of that 468 million ounces of silver in July open interest will be rolled forward, mostly into September. And that will have the effect of causing the price to rise. I've explained how this is what happened in April 2011. I'll explain it again. At the beginning of April 2011, there was about 360 million ounces less silver in May open interest. May is an active trading month. And the price was $37. Over the course of April, that 368 million ounces, all but 7 million ounces of it, was rolled forward into July contracts. The price went from $37 to $49.52 on the 28th of April. And 5 trading days later, on the 6th of May, the silver price was $33. Because the roll had been what pushed the price up from 37 to 49. And once the roll was over, there was no reason for the silver price to keep rising. And it came down, not back to 37, but to 33 within 5 trading days. A very similar pattern may transpire over the next 2 months on the upside, 2 weeks on the upside, and 1 week or 2 weeks on the downside. So buyers beware at this point. If you're a very facile, ultra short-term investor, it's good to know. And if you're a longer-term investor, it's also good to know. But that's one of the major factors. Now, we've also seen investors buying a lot of ETFs. Coin dealers and precious metals dealers continue to report that more investors are selling their silver at recent current prices, prices over $34, 34, 35, 36, 37. There are more investors selling their coins and their 1 ounce medallions and their 10 ounce and 100 ounce bars than are buying it. And some coin dealers, retailers across the country are facing cash shortages because they're putting out so much cash. There are other investors who are buying these things, although according to the U.S. Mint's website, it has not sold any silver coins to dealers yet this month. Half of June is gone, and they're showing very few gold coins having been sold and no silver coins being sold. But you are seeing a lot of investment buying in the ETFs. ETF holdings of silver, physical silver, have risen 21.7 million ounces since the beginning of June. Of that, let me just make sure, 14.8 million of that occurred in the 3 days between the 3rd and the 5th of June, when the price was starting to rise. Investors who are interested in having exposure to rising silver prices have been buying ETFs. These are people who want exposure to rising silver prices. They don't necessarily want physical silver. The easiest way for them to do it, in most cases, is to buy ETFs. So you've seen 21.7 million ounces of silver bought in June so far, in the first 2 weeks of June, in ETFs. While people who sell precious metals, physical precious metals to investors, say that they're seeing more sales back to them than they are seeing new purchases by investors. So that's sort of where we are right now in terms of the silver market. Watch that open interest. And you can get the open interest data daily for free yourself by going to cmegroup.com. It's there. Now, one of the things that we are hearing is that the shorts are bailing out, not only in the July contract, but across the board. And I'll get to the shorts in a second, but first let me show you large institutional investor commitments of traders' positions. This is through June 3rd. That's the most recent data the CFTC has made available. It will release data for 10th of June, this Tuesday, later this afternoon. But I'm not going to wait for that to do this video. We're doing this video now. And you can see that over the last several months, I apologize for the horizontal legend on that one chart. It starts in January 2014. And I used that one so you could sort of see on a more granular basis. On the right-hand side, that goes back to 1996. And you can sort of see how investors tend to be long silver. There was a period of time where they were much more willing to, in 2017, 2018, 2019, willing to be short silver. But they got rid of most of those positions by 2019. And they've gone back to a more normative level, although larger than it used to be, of short position, gross short positions. Most investors play silver on the long side, so the gross longs, the yellow part, are there, and it's been rising. And you have seen some investors reduce their short positions so that the black line, which is the net position, actually has been rising in recent weeks. But the place where the conspiracy theorists go wild is the commercial traders are mass liquidations. This is the silver open interest of commercial entities on the Comex contract across all contracts. So it's not just the July contract. And the red stuff is the gross short. And you can see there really hasn't been a mass liquidation. There's no real panic there. There has been a reduction on the green side, which is the gross long side. There has been lightening up because as the price has risen, other commercial traders have reduced their positions on the Comex. But what you're really seeing is you're not seeing a mass liquidation of short positions by commercial entities. Those banks that are said to suppress the price are not panicking and dumping their silver positions because those silver positions are hedges of physical positions. They're price neutral insofar as that exposure. Yeah, they're not losing money because the price of silver is rising. They're making more money, and they probably will be reporting record levels of profits on their silver trading because the price is higher. Another thing you keep hearing is that there's been this massive liquidation of the overall interest on the Comex silver futures contract, presumably in some of these wild theories that have absolutely no credence, because people are worried that the Comex is going to fail or not be able to deliver, et cetera, et cetera. And you can see total open interest, it's about 900 million ounces across all contracts right now. And, that is down from where that peak was in 2019, 2020, but it's up from where we were in 2021, 22, 23. So there hasn't been a mass liquidation of overall contracts in the Comex silver, despite what you might hear from some crazy people. And it's funny because, we had a reporter and she asked me, how do you see this mass liquidation of silver positions? I said, I don't. Yeah, I can't explain it to you because I don't see it, because it doesn't exist. The question is not why are people liquidating their silver positions. The question is, why would anybody believe anyone who was saying that when you can go online and find the data that says this guy's lying to you? Like, a third lie is that investors are bailing out of the treasuries. They don't want exposure to the U.S. Treasury because of the massive debt and deficits that we're running. So people are dumping treasuries and they're not buying new ones. And there has been a lot of talk, both in mainstream and in the dark corners, of how the Treasury was running at, I think it was $22 billion, 30-year Treasury. That 30 years, the longest maturity they have, 30-year Treasury bond auction yesterday, and no one was going to bid for it because no one wants to have credit exposure to the U.S. Treasury for 30 years. Now, these are the 10 years, and 10-year notes is the major place where you see that. And you can see the blue line is the bid to cover. So for any given $10 billion of bonds that the Treasury is running, they tend to get 2 to 2.5 times as much bids for what they're actually offering, because there are more buyers than one seller. And that actually has risen a little bit in the last few years, but it's basically in line with what it's been for most of the decade since 2015. Bloomberg has this chart, and this is all of the Treasury's yields from 90-day up to 30-year. And the magenta, which you can probably barely see, is the 30 years. And you can see that it actually has come down a little bit from where it was like a year ago. But in yesterday's bond offering, the bid to cover ratio was 2.43, which is actually, it's right in the middle here. So the expert predictions that no one would bid for the 30-year treasuries due to our government's perennial financial mismanagement turned out not to be accurate. That's because globally, investors still prefer U.S. government risk, financial risk, than they do others. Got a couple more charts. U.S. CPI, it came down to 0.1% on a month-to-month basis in May, That was because of about an 11% decline in oil, petroleum products. Consumer price index doesn't include petroleum. It includes gasoline and heating oil and other petroleum products. And those were off sharply. Everything else was pretty much flat. And you can see that here. The blue line is the all items. So you can see 2.4%. This is year over year. And that's kind of low. It's been low. It came down sharply March, April, May. That's when the oil price was falling sharply. It come up a little bit from April to May. But if you look at the maroon line, which is all items less the more volatile food and energy, it's been flat for the last 3 months. And again, I want to repeat this thing because you hear people saying, well, the effects of tariffs aren't showing up in the May CPI and PPI data. We also had, came out on Wednesday. On Thursday, we had the producer prices, and they're pretty much, bumping along where they have been. A little bit higher in some indices, a little bit lower in other indices. But again, you haven't seen the effects of the tariffs because by and large, they haven't taken effect. And most of the things that people were buying in May had already been bought. And if they were imports, they had already been imported. So it's too early to really talk about those consequences of what's going on. The Secretary of the Treasury was testifying this week or last week at Capitol Hill, and he was saying, and the Congress people, the Democrats at least, were railing him about the explosive growth in deficits and debt that will be a consequence of the Trump economic policies. And he said, well, actually, the deficit is, according to the CBO, going to contract some this year in this year's budget. It's actually contracting some. So we don't see this as having a major negative effect on deficits. Problem is, for him, this year's budget was created a year ago when Biden was president and doesn't really reflect Trump economic policies yet. And if you look at the CBO, they're talking about massive increases in deficits and overall debt over the next 5 years based on the big, beautiful budget bill that is now rightly stalled in the Senate and should be torn apart and rebuilt because it's got a lot of nasty stuff in it. But in terms of PPI, CPI, you're not seeing the effects of Trump policies yet. You may start seeing them in the second half of this year. You shouldn't be surprised if they're not showing up here. This is the data that's on the PPI. And again, total final demand, price increase 0.1%. You can break it down, 0.1% in final demand for less foods and goods, 0.2% for final goods demand on a PP, and 0.1% on transportation. That's all I have for now. Take care of yourself. Take care of those around you. If you want, you can go to our website. You can order our gold yearbook or silver yearbook for 2025. Download them as PDFs. You can pre-order our platinum group yearbook, which will come out in late July. You can subscribe to other reports that we produce or read about other services that we have. There are a lot of free reads and videos posted there. And you can always send us an email at info@cpmgroup.com asking us how we can work with you to improve your commodity and precious metals investment performance. Take care of yourself. Take care of those around you. Have a good weekend. Stay safe. Try to do something good for the world. And we'll talk to you next week.